Hey everyone, my name is Reese, and in this video I will be talking about the power of dividend investing and whether or not you should reinvest those dividends. And it is a pretty hot topic, but it also depends. I truly believe that it truly comes down to your personal scenario as far as what might work best for your situation. However, I'm going to be talking about some of the pros and cons of whether or not you should reinvest your dividends or use those dividends as a form of passive income, and talk about what might suit your purposes better depending on your situation. So to start off, what I'm going to be talking about in this video is I'm going to be comparing three ETFs. One is SPY, which is an S&P 500 ETF. Another is VYM, which is a Vanguard High Dividend Yield ETF, and then VIG, which is a Vanguard Dividend Appreciation Index Fund. And I've done a video before talking about these ETFs and what they aim at targeting, but quick recap: VYM essentially just going to have an index fund that pays out higher than average dividend yields, and then VIG is focusing on companies with a history of growing dividends. And so to start off, what I want to really get at is what is the difference in returns regarding if you reinvest those dividends or not. So here is a visualization. So SPY is shown in red, VIG, which is the dividend growth, is in orange, and then VYM, which is the high dividend yield, is in blue. And I've talked about this before, but one of the big things when it comes to dividend ETFs or dividend investing as a whole is typically the higher the dividend yield, the lower the capital appreciation of that fund or stock. Meaning, so VYM, which has I believe it's about double the yield of the S&P 500 currently, it has lagged overall. So if you had invested in November 2006, before the financial crisis in 2008, you would have got a 96% return in VYM, 158% return with VIG, and then 160% return investing in an S&P 500 index fund. Now keep in mind this is without reinvested dividends. So as you can see, the growing dividend yield has been the high dividend yield in terms of appreciation, and it's kept pretty on par with the S&P 500 as a whole. Now here's things get interesting. When we reinvest those dividends, suddenly the picture kind of changes a little bit. Now VYM, the high dividend yield, went from a 98% return to 220% return. This is if you had done a lump sum investment in November of 06 and kept those shares in the market and reinvested those dividends as they came in. And so you are getting more than double the return of VYM in the long run if you reinvested those dividends. And now the dividend growth in the S&P 500 are about 258% return, comparing that to 160%. So you are getting almost an additional 100% return if you had reinvested those dividends in the long run. And this can also be shown here. So this is portfoliovisualizer.com, which is a pretty neat tool that you can use to compare and backtest different portfolios based on your chosen allocations. And for this comparison, try to put some hard numbers on it. So this is going to be comparing a portfolio of VYM, SPY, and VIG, so the high dividend yield S&P 500 and dividend growth ETF, with an initial deposit of $10,000, reinvesting our dividends. So we analyze portfolios, and with an initial deposit of $10,000 in the high dividend yield, you would have been left with $29,900. SPY. This is an investment date of December 31, 2006. So a little bit different than what the TradingView calculator did, but so initial, so almost a 300% return overall with VYM. SPY is 34.3 thousand, so 343%. And then the dividend appreciation is 34,682. So it's, as of right now, it's slightly beating the S&P 500, so 346% return. And comparing that to the same thing, except without reinvesting dividends, we are seeing a much different story. So let me compare side by side. One on the left is without reinvesting dividends, and on the right is reinvesting dividends. So we're seeing more than 50% performance gains by reinvesting those dividends. And reinvesting the dividends also shows that VYM can have much better returns when you reinvest those dividends. Okay. And another thing to keep in mind is the dividend payouts. So in 2021, you would have got $599 with VYM by not reinvesting dividends. And then if you had been reinvesting your dividends, you would have got $938. So a little more than 50% dividend income as well by reinvesting. Okay, so now that we have some numbers, the math shows that if you are reinvesting your dividends in the long run, you are going to feel the power of compound investing and the dividend snowball effect, where as you're reinvesting those dividends, you're able to purchase more shares of stock over time, and your stocks are buying more of itself over time just with those dividends. So it's compounding itself, and as you get more shares, you can buy more. You can get more dividends, which will allow you to buy more shares, and then it compounds and compounds. And if you held like a dividend fund or pretty much any ETF for over 20 years, you're going to see some really neat yields over in the long run of once you start seeing that effect compound. With that being said, not everyone is going to want or have the goal in mind for a 20, 30-year time horizon to really let those dividend yields compound. Okay, so let's say you're investing in VYM, which has had lower trailing returns, but as of right now, it's paying, I want to say, 3.4% dividend yield. I'd have to double check my memory, but I think it's around there. So if you are someone who is trying to live off of their dividend yields, and their goal of investing is to create a source of passive income to either supplement their regular income or just fully replace it, you're not going to be able to do that if you're just reinvesting your dividends. Because if you need that income now, then reinvesting those dividends isn't really going to suit your needs. However, if you are someone with a long investing horizon and you really don't need to, withdraw those dividends, which I know that if you're getting passive income foreign dividends and you might consider it free money, you're really taking away from your future returns if you don't need that dividend income. So I believe that basically, in simple terms, if you are someone who has a long investing time horizon, you don't need the dividends now, and you are willing to have a delayed gratification when it comes to those dividends, reinvesting those dividends as they come in will allow you to compound your portfolio more, and in the long run, you'll have a much more sizable portfolio, and you'll get higher dividends in the long run that way. On the other hand, if you are someone who, let's say you're potentially nearing retirement age, or you are someone who their goal of investing isn't necessarily to create a more long-term wealth, it's more of you're targeting short-term, potentially more stable value-based plays, which, as we can see here, VYM, for example, it's paying higher dividend yields, it's getting less capital appreciation, but especially right now, that's probably not the best way. Let me see. I'm going to change this to 4 hours. Dividend yield, or high dividend yield, not necessarily high dividend yield, but value-based companies. So I'm going to put this to the peak of the stock market in 2020, right before everything started crashing this year. We've been seeing a pretty big sell-off this year. So VYM is blue. And as of right now, so VYM is going to be typically more value-based than growth, because companies who pay out dividends typically are a little bit less aggressive with their capital, potentially, when it comes to reinvesting into their company and trying to expand their kind of more stable, hence value plays. So VYM has actually been the better performing than the S&P 500, and then VIG has also been slightly overperforming the market as well. So year to date, or from my selected time period, S&P 500 is down 23%, dividend growth is down 19.4%, and VYM is down 11.62%. So by investing in these higher dividend yielding companies, if you are using that to supplement your income, I think that if that's what suits your goals and your needs, I think you're going to be better off investing in these dividend ETFs and living off or supplementing your income with that. Whereas if you have a higher time horizon, looking into something a little more growth minded like an S&P 500 or VIG might be a better game plan. So I hope that made sense. And like I said, it really comes down, at the end of the day, comes down to your own personal specifics and financial situation of what you're trying to do. So yes, the math will check out. If you have a long time horizon, reinvesting your dividends will give you much higher returns. On the other hand, you're having to delay those dividends, and you are not really going to realize income, and you could potentially be having to pay income taxes throughout the life of the dividends. Now, one thing that's really neat about these two ETFs specifically, as well as another one, SCHD, which is a really popular one I recommend looking into, they count as qualified dividends. What qualified dividends are is because these index funds do not include any REITs, which is our real estate investment trusts, they count as qualified dividends, which is taxed on long-term capital gains tax rates. And what's nice about that is capital gains taxes are usually they're much lower than regular income taxes on average. And I believe as of right now, it's up to if you get up to $40,000 in capital gains each year, so up to $40,000 in dividend income, for example, that is tax-free. Now, I do believe you have to pay Medicare and Social Security on that, but you are not going to be subject to, let's say, 20% tax bracket that you might see otherwise on your personal regular income taxes. So that's really neat about these dividends is, yes, you can get tax on it, but if you play your cards right and you're investing in qualified dividend-paying companies or index funds, you can really save yourself that time or energy when it comes to dealing with those taxes and just the headache of having to pay taxes every year on your dividends. And so no one wants to deal with that. So qualified dividends are a pretty nice way to supplement your income. So hope you guys enjoyed. Hope this made sense. If you have any content suggestions or recommendations, feel free to leave a comment below. I'd be happy to check it out and see if it's something that looks like I can do. Hope you guys enjoyed. Hope you guys have a great rest of your day. If you like this content, feel free to like, comment, or subscribe. It's free to do any of the what I just said. So I hope you guys enjoyed. Thanks for watching. Have a great one.